What is intrinsic value? Intrinsic value is the true underlying worth of something, not the price tag, not the market hype, but what it's really worth based on its actual qualities. In investing, intrinsic value usually refers to what a company or share is genuinely worth once you take into account its profits, assets, growth potential, and risks. Think of it like a house. The asking price might be £250,000, but its intrinsic value depends on the size of the rooms, the strength of the foundations, the neighbourhood, and the potential for future improvements. Price is what you pay, but intrinsic value is what you actually get. Why does it matter? Because in the stock market, price and value aren't always the same thing. Share prices move up and down every day, often based on mood, headlines, or speculation. But intrinsic value is steadier, is tied to the real performance and long-term future of the business. Understanding intrinsic value gives investors an anchor. Instead of being swept away by short-term noise, you can compare the current price with what you think the company is really worth. If the price is much lower, it might be a bargain. If it's higher, it could be overpriced. Warren Buffett summed this up neatly when he said, "Price is what you pay, value is what you get." Once you've worked out intrinsic value, that's when the idea of a margin of safety comes in. You don't just want to pay fair value, you want to buy below it, so you have a cushion in case you're wrong. Here's a simple example. Imagine you're looking at a company that makes sports shoes. You study its yearly profits, think about how much it could grow, and add up the value of what it owns, like factories, designs, and equipment. After weighing it all up, you decide each share is worth £12. That's your estimate of the company's intrinsic value. But on the stock market, the share might be trading at £8. If so, it's selling for less than you think it's worth, which could make it a good buy. On the other hand, if the price is £15, you'd be paying more than your estimate of its real worth, which makes it riskier. You can see the same idea in everyday life. Imagine buying a second-hand car. Two cars might both cost £5,000, but one has low mileage, a full service history, and a solid engine, while the other has hidden problems. The price is the same, but the intrinsic value of the first car is clearly higher. What else should you know? Working out intrinsic value isn't an exact science. Investors use different methods. Some focus on the company's cash flow, the money it brings in. Others look at its assets, what it owns. And some focus on earnings or future growth potential. The important point is that intrinsic value is always an estimate, not a perfect answer. Because of this, two people can look at the same company and come up with very different numbers. One might think a share is worth £15, another might say £10. This subjectivity is what makes markets possible. Every buy or sell is really just one person's opinion meeting another's. It's also a mistake to see intrinsic value as fixed forever. A company that looks valuable today might struggle if competition increases or demand falls. Likewise, a struggling business might become more valuable if it reinvents itself successfully. And here's a key misconception. Some beginners believe intrinsic value is a true number, hidden somewhere in a company's accounts. In reality, it's a best guess. The goal isn't to be precise down to the penny, it's to have a sensible idea of whether you're paying far too much or whether there's value hidden beneath the surface. To sum it all up, intrinsic value is the real worth of an investment based on what it actually earns, owns, and could achieve in the future. It's different from the market price, which bounces around daily with sentiment and speculation. By estimating intrinsic value, investors gain a compass to help them spot bargains, avoid overpaying, and think more like owners than gamblers. And when you combine it with the idea of a margin of safety, you get a simple but powerful strategy. First, estimate what something is worth. Then, buy it for less to give yourself room for error. If there's one practical takeaway, it's this. You don't need to know intrinsic value exactly. Just having a rough sense helps you avoid paying too much for too little. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.